My name is Jordan Stewart. I'm a portfolio manager at J.Pmogan Asset Management, and I work in the multi-asset solutions department. And I look after global portfolios where we allocate across stocks and bonds and across all major developed regions and emerging market regions, as well as across the fixed income spectrum.
My name is Craig. I'm a global market strategist, part of our market insights team at J.Pmogan. We're a team of about 40 individuals based around the world whose job it is to help others understand the capital markets, understand the macroeconomy, and put the pieces of investing puzzle together.
The J.Pmogan LTCMA stands for the long-term capital market assumptions. And as the title says, they are assumptions for forecasts over the next 10 to 15 years. We make forecasts for over 200 different asset classes, and we do it in 17 different currencies. And we translate those potential forecasted returns across those currencies. And we've been doing it for 28 years. It is one of the most foundational and important pieces of work that we do in J.Pmogan Asset Management.
In the long term, we still see very respectable returns for the Korean equity market and our long-term capital market assumptions. Some of the headwinds that other economies face or markets face in terms of valuations and margins are very much moving the other way for Korean equities. In the near term, our outlook for Korea really does focus on the fact that valuations have come back down to roughly their long-run average on the MSCI Korea, and also the fact that we could see an uptick in the global goods cycle and semiconductor cycle, which would favor the Korean market as well.
In the short term, we think that assuming there's no recession, that the Korean equity market and the Korean market in general is attractive and there are opportunities. We think that valuations are pretty attractive at a price to book level, also in PEs, relative to the historical norm. We also think there's the potential for a tailwind if there is to be more fiscal spend in places like the United States who are looking to invest in their defense sector, because there will be a higher demand for chips and semiconductors, which could benefit the Korean market. Overall, we think that we are seeing the potential of a rebound in the semiconductor cycle, which should be beneficial for Korean equity markets. On the long term, we still believe that the Korean equity markets can generate around 6.8% return in local currencies, which is quite attractive. And in that expectation, we think that there is part of that is an increase in profit margins. And we think that corporations have the ability to further improve their profit margins from where they are today. So both on the long term and the short term, we think there are opportunities in the Korean market.
My investment philosophy is very much one of the long term. There is volatility in the markets in the short term, but a long time horizon can obviously negate that. I think it's also important to think about the diversification benefit that comes within stocks, bonds, but also where liquidity allows alternative assets, and thinking about the benefit they provide in enhancing alpha returns, providing income, or even diversifying portfolios.
Our investment philosophy is to first think through the long term and understand on a cycle neutral basis what are the potential returns in different asset classes. We believe in diversification across both stocks and bonds, across various different regions, and across different asset classes. And we think about utilizing all of those in toolkits in the toolbox to create a portfolio that minimizes risk while trying to maximize return for our investors.
There has certainly been a strong correlation between the movements in yields and the movements we've seen in equity markets, given the valuations can be sensitive to those risk-free assets. Over the course of this year, the market has gone from debating whether there'll be a recession in the US, thinking about a soft landing, and then thinking about whether financial conditions are tight enough to actually create that perfect Goldilocks scenario. Our view is that central banks, whether in the US or around the emerging world, are very much at the end of their rate hiking cycle. that yields are high enough to restrict their access to credit in the economy and will lead to a slower growth profile. This is very different though than thinking about the prospects for rate cuts from many central banks, especially the big developed ones, whether it's the European Central Bank or the Federal Reserve in the US. We're still in an environment where we see weak growth, but inflation that's above their target, and so they're unlikely to be quick to move to cut those rates until they see a much bigger downshift in the economic activity, which would suggest they need to normalise that policy. Our forecast is that the European Central Bank and the Federal Reserve won't start cutting rates until the third quarter of next year, but even then it's about the number of rate cuts they price for next year and compared to what the market is thinking.
So in a general 60-40 portfolio, what we can expect and what we've seen in the past is that if there's a growth shock, the bond allocation can help hedge against that downturn. But what we saw in 2022, when we had an inflationary shock, both stocks and bonds went down together. There was a positive correlation which hurt multi-asset portfolios. What's interesting is that alternatives and different asset classes within the alternative space performed well during that period. The ability for alternatives to pass through some of the inflation and benefit from it is one that makes them more diversifying and can help protect against shocks from inflation.
The most preferred asset that I would look at for 2024 is certainly core government bonds. Thinking about the downside to yields from here and thinking about locking in those higher rates now before they fall much further.
Our long-term capital market assumptions are looking again at 12 to 15-year horizon, but we do believe that over the course of averaged over that time, that the asset allocation of a 60-40 portfolio will be beneficial to investors. Having bonds in the portfolio will help if there's a growth shock. Also, with potentially including alternatives in your portfolio, that can protect against an inflation shock. We think that the 60-40 portfolio is expected to return something around 7%, which is a good return over the next 10 to 15 years. For next year, we believe that it still has validity and can help investors generate returns. Target date funds and a glide path are portfolios, a strategy in which you glide down and basically dynamically decrease risk as a participant gets closer to retirement. The purpose of a glide path is to help people invest their money appropriately for retirement. In the earlier stages of a glide path, you have mostly equities and a lot more risk. Towards the end, you decrease that risk, which becomes more important for individuals as they get closer to retirement. They don't have as much time to make up for portfolio losses if there is a downturn in markets.
For investors looking to invest today and the opportunities around the world, we are still relatively cautious when it comes to adopting risk assets such as equities. We do have some concerns around the downside risk to growth that you could see materialize in the US. We see Europe heading towards a recession, and very much when it comes to China, a case of stabilization rather than thinking about acceleration in its economy. Because of that, we do see some risk to the earnings outlook, given the both top-down pressures from that slower growth environment, as well as some of the pressures on the bottom side, thinking about those higher financing costs coming through. Because of this, we do lean to a quality bias when it comes to the equity market. We are thinking about US large caps still as valuations come down. We are also looking to better markets such as Japan, given there is very much a difference in the structural change we're seeing in the economy there and the outlook for markets. We do prefer to think about fixed income a little more in this environment, both that investors should be rewarded as rates and inflation come down in duration, and also thinking about the quality bias that comes with investment grade credit, given that yields are high and it does look like a relatively attractive risk-reward trade-off. And I think that can extend to a certain extent when we think about high yield, given the fact that yields on US high yield are close to 9%. Even though there may be some pickup in default risk, it does provide quite a large cushion against that.